So welcome to this video. In this video, we are going to look at the investment appraisal methods. So these are the methods that we are going to look at in this video. The payback method, when cash flows are constant, when cash flows are not constant, then we'll be looking at a discounted payback method, then NPV method, then at ARR method, so on original investment and on average investment, and we'll end this video with IRR method. So we'll start with the payback method. So we'll see how this works. So this is the first. In payback method, there are two ways to do it. So the first method is when cash inflows are constant, then you can use this method. So the formula works like this: payback equals to initial investment divided by annual cash flow. So the answer that you will get in is payback in years. That's what the answer refers to. Okay. So the selection criteria is select the project which has the less years. Okay. So the lower the better. So we'll do this problem. Calculate the payback period and indicate which project is to be accepted. Also explain the criteria to choose the payback, to choose based on the payback. So there are two projects here, project X, Y. The investment is given, the annual cash inflow is given. So it is constant. So that's what they have given it as a single number. So if it's going to be a differing number in each year, they would have given you that. But as it's the same number, the cash inflow is constant. So only for when the cash inflow is constant, we can use this method. And they have also given you economic life of that project. So we'll start for project X. Okay. So the formula works like this. 35,000 is the initial investment divided by the annual cash flow. You will get the answer. So the answer comes to 2.3 years, 2.33 years. And for project Y, we'll look at the answer. It comes to 15,000 divided by 7,500. So the answer comes to 2 years. So which one you have to select? You don't need to look at the economic life of the asset. That is not at all required. Okay. You have to just look at which project has the lowest payback period. So project Y has the lowest payback period. So select project Y. Okay. So that's about it. This 2.33 years can also be found out like this. For example, 2 years and the balance 0.33, okay, refers to the month. So you can take it as 12 months. You can multiply it by 12. You will get an answer like this. 2 years and you get roughly 4 months. So this project can also be said as 2 years and 4 months of payback period. Okay. So the question will state you whether it wants in point like this or it wants in year and month. Okay. So based upon that, you can work out it. We'll go to the next problem. So here we take payback in years when cash inflows are not constant. For this, we don't have any formula. We have a table and we have to use that table to get an answer. So we look at it. But the selection criteria is the same. Select the project which has less years. A company has two projects of which only one can be selected. The cost of each project is 1 lakh. Use payback criteria. So they have two projects and we have to tell which project is better. So we'll start with project A. So project A, we'll do the payback. So we'll start from years, cash flow, cumulative cash flow, okay. So that's what we have to compute. Years is 1, 2, 3, 4 and 5. Cash flows are 50,000, 40,000, 30,000, 20,000 and 10,000. So you have to accumulate. So you have to add just the first year we get only 50,000. Next year we get 50 plus the 40 we get 90. So we accumulate it. The next year this 90 plus 30 gives us 1,20,000. We are just cumulatively adding it. 1,20,000 plus another 20, we get 1,40,000. 1,40,000 plus 10,000, we get 1,50,000. So we have cumulatively added it. So now we will work out the payback. So the payback works like this. First, find out what is the total investment. The total investment is 1 lakh. Okay, look in which year it is crossing that 1 lakh. It crosses in the year second to third year. So it means that between the second year and the third year, the payback is situated. So minimum you need how many years? You need 2 years. Okay, minimum you need 2 years because you have to recover 90. So we'll again open a bracket. Total, what was the investment? Total investment was 1 lakh. Out of that, in the second year, how much have you recovered? You have already recovered 50 under 40, so 90,000 has been recovered. Okay. In the third year, okay, in the third year alone, how much of cash flow you're going to get? In the third year alone, you're going to get 30,000. So close the bracket. The formula is over. Okay, so 2 plus solve the inside. So 10,000 by 30,000. So 10,000 divided by 30,000 is the answer. So that comes to 2.33 years. So that is the answer. We got 2.33 years. Okay. Our job is like very simple. Ensure that you understand this formula. There is no explicit formula to be written for this, and no book has like specified that. Your job is to just understand the logic and get the answer here. If you want a better understanding, we can put it like this. See, in this 2 years, we have recovered how much? 90. How much balance we have to recover? Just 10. That is this 10,000. In the third year, okay, how much we are going to get? We are going to get 30,000. It means that within 0.33 of the third year, okay, 0.33 of the third year, we will recover the amount. So it is like in 1/3 of the third year, okay, in the 1/3 of the third year, we will recover the total 1 lakh. So that's what this works. So ensure that you understand. For project B, you try to do the answer. So if you want, I will tell you like how the answer would be. So without even doing the problem, we will try to see like how it works. For example, 1 lakh has been invested. You have recovered 20 in the first year, 20 plus 30, 50 in the second year, 50 plus 40, 90 in the third year. How much still you have to recover? Just 10,000. So 10,000 divided by 50 gives you 0.2. How many years you have taken? You have taken 3 years. So you have totally taken how many years? From here to here you have recovered 90,000. In the fourth year you have to just recover 10,000, but you get 50 in the fourth year. So just 0.2 of 4 years is required. So project B should ideally take you 3.2 years to recover the amount. So that is the payback for project B. So you guys try to work out this and try to get the answer for it. Okay, we will move on to the next problem. So here's another problem which is like very similar to the last problem, but there is a difference here. A company is considering an investment of 4 lakhs in a new machinery. The machinery is expected to yield incremental profits over the next 5 years as follows. Okay, so I think we will strike off the word incremental. That is like not correct. Okay, so expected to yield profits over the next 5 years as follows. So these are the amounts you got, but it's profit. When compared to the last problem, there was like cash flows. So payback always deals with cash flows, not profits. If the question specifies you profit, you have to convert the profit to the cash flow. So how do you do it? See, normally what happens is when you get profit, okay, and then you add the non-cash expense, okay, any non-cash expense, if you add, you will arrive at the cash flow. So that's how it has to be like computed. So if they have given profit, they would have given you some kind of a non-cash flow expense, add it back and you will get the cash flow. So we'll read it. Thereafter, no incremental profits are expected are expected and the machinery will be sold, it is company's policy to depreciate machinery on a straight line basis over the life of asset. The machinery is expected to have a value of 50,000 at the end of the 5 year. Calculate payback of the investment in this machinery to the nearest 0.1 years. So in this problem, before doing the payback, we have to find out the profit. So what we'll do is we'll start from year. Okay, so we have years, we have profit. Okay, with profit we have to add the non-cash expense. In this sum, the depreciation is the non-cash expense, so we'll add the depreciation back and then we'll get the cash flow. So we'll have year 1, 2, 3, 4 and 5. We'll add the profits. Profits are 1,75,000, 2,25,000, 3,40,000, 1,65,000 and 1,25,000. So we have to add the depreciation. So our depreciation, we'll do a separate calculation here. So depreciation equals to the value of the machinery. What is the value of the machinery? Minus scrap divided by the number of years of machinery. So the value of the machinery is 4 lakhs minus what is the scrap? The scrap value is 50,000 divided by total life of 5 years. You will get the answer. So 3,50,000 divided by 5 will give you 70,000. So 70,000 per annum is the depreciation. So add 70,000 to all the numbers here. You will get the cash flow. So what is our cash flow? Our cash flow is 2,45,000 here, 2,95,000 and 4,10,000. I think we will stop that. We don't need to proceed further there. We'll work out the payback. So we have to find out the cumulative cash flow. So cumulative cash flow is 2,45,000. Add this, you will arrive at this number, 5,40,000. Okay. See, we don't need to do the full table. Whichever year we are going to cross the 4 lakh, the investment, we can stop there. Okay. So we don't need to continue further, and we don't need to like keep on doing the problem over a period. So what we can do is the investment of 4 lakhs is recovered between these 2 years. So we'll find out the payback. So the payback equals to how many years? Minimum you need 1 year to recover the amount. Okay. How much you have invested? You have invested 4 lakh. How much you have got in the first year? You got 2,45,000. Okay. How much you are going to get in the second year alone? In second year alone, you are going to get 2,95,000. Solve it. The answer comes to 1 plus 0.525. So it's 1.52 years. Okay. So the answer requires you to put it in 0.1 years. So after decimal, they need just one number. So after decimal, we have taken even two numbers. Okay. So that's about the answer. So first to work out, solve this part. The answer comes to like 1,55,000. Then divided by 2,95,000. So you got the answer. The payback is in 1.5 years. So we have a next problem. It's called as discounted payback method. Okay. So it is a usual payback sum, but here we have a discounted element to be added. So we'll see like how this method works. The company has to decide whether to invest in projects or not. The cost of each project is 1 lakh. Use discounted payback criteria. The cutoff rate is 10%. So these are the cash flows. So in a discounted problem, they will always give you the cutoff or discount factor or required rate of return, or they will give you cost of capital. Okay. So these are the other substitute words that are being used for the percentage, but normally there will always be a percentage, and that percentage is the discount factor. So we'll do the sum. So again, we have to start with years. Then we have to get the cash flow. Then we have to get the discount factor at 10%. Then we have to get the discounted cash flow. Then we have to get the cumulated discounted cash flow. Okay, so we don't need to do the full sum. Wherever we could end up with 1 lakh, that is more than enough. So we'll start from there. 1, 2, 3, 4 and 5. So the first year is 50, 40. Factor is we can look at the table and we can get the numbers. So we have the numbers here. So this is the present value table. The number that we want is for the 10%, and for 5 years we want is 0.909, 0.826, 0.751, 0.686, 0.621. So we have got the numbers from that. The next step is to multiply these things and we have to get the discounted cash flow. I think we would cross the 1 lakh amount here. So I think we can stop. So the investment has crossed 1 lakh here. So we have to find out these here are our relevant years. So we'll work out the payback. So the payback is we have crossed the investment in which year? In the second year, plus the total investment that we made is 1 lakh minus the amount that we got in the second year is 78,490. Okay, and in the third year we will get 22,530. So we'll see the answer. So the full solution comes to 9.95. So the answer comes to 2.95 years. So approximately it is 3 years. Okay, that's about this problem. So if they are going to give this kind of a problem, then there's no other way. You have to find out the discount factors and then get the answer. Okay, so we'll move on to the next problem. Accounting rate of return, or ARR. So the uniqueness of this method is this is the only method which uses profit. All other methods in investment appraisal uses cash flow. So what you do is the selection criteria here is the higher the return, the better the ARR. You have to select that project. So here we have two methods for solving this ARR. So one is called as the ARR on original investment, and the formula works like this. ARR equals to average annual profits before interest and tax. So it's average annual PBIT divided by initial capital cost into 100. So the answer is always in ARR is always in percentage. So we'll start with the problem. The company is considering the purchase of a machinery costing 1,20,000. The machinery will generate an average annual profit of 20,000 for the entire 5 years. Starting in year 1, the machinery purchased will have a scrap value of 10,000 in 5 years time. Depreciation is on straight line basis. Our job is to determine the ARR. So first we'll do it with the initial capital cost method, okay, or the ARR on original investment. So how do we do it? So ARR on original investment, we'll put it as OI. So average annual profits before interest and tax, they have given us it directly. Okay, so 20,000 is the average annual PBIT for entire 5 years. So they have divided for the 5 years. Okay, so you don't put divided by 5 and get the average, because they are this 20,000 itself is an average. Okay, the question has given you depreciation, but what we'll do is we can make an assumption. The assumption is the profit is after the depreciation. So this 20,000 has considered the depreciation and we have got the profit. Okay, so 20,000 is our average annual profit for 5 years. The denominator would be the total investment in the project. So that comes to 1,20,000. So into 100, we'll get the answer. So the answer would come to 16.67 percentage. Okay. So this assumption is based on that the profit has been already deducted the depreciation part. Okay. If that is the case, this would be the answer. So we'll look at the next question. ARR on average investment. So what is an average investment? The numerator remains the same, but the denominator changes. So the denominator works like this. Average capital investment, okay, into 100. What is average capital investment? Average capital investment equals to the initial investment plus the scrap value divided by 2. So we'll again make the same assumption. The assumption is that the profit given has considered depreciation. So that is an assumption we'll make. Okay, so we'll start. So ARR on average investment. So the numerator is not going to change. It's the same 20,000. But if you take the denominator will change. How? The initial investment was 1,20,000 and the scrap value is 10,000. So first take an average of for this, then only you can further proceed. So into 100 will give you the answer. So to proceed, we have to solve the denominator. So the denominator will come to 65,000. Our answer comes to 30%. Okay, so that's about the ARR on average investment method. So the denominator is the one which changes. So just note that. Go to the next method. So here again our job is to find out the ARR, okay, on initial capital cost and average capital investment. But the only change in this question is they have given you the cash flow, but we don't require cash flow in ARR. We need the profit. Okay, so we'll read the question and we'll understand. The machinery requires an initial investment of 8 lakh and then earns cash inflows as follows. So cash inflows have been given. At the end of 7-year project, the assets initially purchased are sold for a amount of 1 lakh. We have to find out what's the project's ARR. Okay, so we'll take any one method. I think we'll take initial cost method and we'll do it. So we'll start. So first, cash flow has been given. So what happens here? See, normally profit plus depreciation will give you the cash flow, but in our case cash flow has been given and we need profit. So in that case what we'll do, from cash flow we'll deduct the depreciation because we are going in reverse. We'll deduct the depreciation and then we'll get the profit. First we'll find out the depreciation. Okay, then we'll move on. Depreciation per annum. So we'll cut the zeros and we'll get the answer in 1000. So the asset value is 800 and 8 lakh and the asset has been sold for scrap for 100. So our total depreciation is 700. Here we have to get a number called as annual average profit. So the number that has been given is cash inflow. With cash inflows we will deduct the depreciation, because with profit if you add depreciation you will get cash flow, but when you have cash flow and you want profit you have to deduct depreciation. So deduct depreciation, you will get the profit divided by, we have to get the average. So annual average means we have to put the year in the denominator. So we'll try it out. So the total cash flows comes here, it comes to 1750 minus the depreciation is 700 divided by 7. So the answer comes to 150. So that is the annual average profit. So we'll do ARR on original investment method we'll do. So that comes to 150 divided by 800 into 100 will give you the answer. So the answer comes to 18.75%. So if you want to do the ARR on the average investment, we'll do it here. So the 150 remains the same, but the denominator alone changes. So the denominator changes as investment plus the scrap. The scrap is 100. So both numbers divided by 2. So our answer comes to 150 divided by 450. It's always 100. So the answer comes to 3%. Okay. So we've done both methods and we got the answer. So that's how you have to work. So always ARR uses the profit, not the cash flow. If they give cash flow, find out the profit. So hope you have understood. We'll go on to the next method. So this is a very, very important method and it's called as NPV, net present value. So NPV works like this. NPV is nothing but the present value of cash inflow minus the present value of cash outflow. The criteria is the higher the NPV, the better. If it's a positive NPV, it's better. So we'll work out the sum. A company has decided whether to invest in project or not. The cost of each project is 1 lakh. The NPV method use NPV method criteria. The cutoff rate is 15%. Just like discounted payback method, we have the cutoff rate. So this cutoff rate is the discount factor. And the project has cash flows of 5 years. So here you have to take all the 5 years cash flows into account, then only you will get the answer. So we'll start. So here cash flow, discount factor at 15% and present value. So here the important thing is always consider the first year, the 0th year. Okay, 0th year is the first number that has to come. Then you take like how many years the problem gives you. Now we will take the cash flow. For the 0th year, we have 1 lakh, but this 1 lakh is the purchase of machinery. So it has to be minus 1 lakh. Okay, it's a cash outflow. From there on, everything is a positive number because they are cash inflows. So the discount factor for the first year is always 1. The 0th year is always 1. Okay. From there on, we have to do the discount factor numbers. So discount factor is 15%. We look at the present value table. If you look at the present value table, you can get the answer quickly. So these are the numbers that we need. So the numbers that we require are, so we got these numbers. So the next step is to multiply these numbers and get the answer. The first year it is a negative cash flow. From there on, you just multiply with the relevant numbers, add all them, you will get the NPV. $9,890. So as it is a positive NPV, you have to accept the project. So that's about the NPV and the criteria. If the problem has a scrap value, okay, if the sum has a scrap value is a cash inflow. It's an inflow of cash. So what you do is in the last year you just add the scrap. So usually it comes and gets added in this year. Okay, so assume the scrap value is like 2000. So you add the 2000 to the 5th year, so that comes to 12,000. So you can multiply 12,000 into 4.497 and then get the answer. So adding the scrap value is also important, but in this problem we don't have the scrap value. So that's about the NPV method. We move on to the next one. So we'll start from this method. So this is called as the IRR method. So IRR formula works like this: the L plus NL and NL minus NH, H minus L. So when we do the problem, we can understand it. So here is the explanation which is being like given. NL refers to NPV at lower rate, NH refers to NPV at higher rate, H refers to higher rate, and L refers to lower rate. Here the selection criteria is you have to select the project which has the highest IRR. Okay, and that's how it works. We look at the problem. So it states A and Co is considering a project which requires an investment of 60,000. The cost of capital is 13%, and they have given you the estimated cash inflows. The cash inflows are 15,000, 20,000, 30,000, 20,000 for the fourth year. Our job is to calculate the IRR and tell whether the project can be disinvested or not. Okay, so here we'll start. This is a lengthy sum. Okay, so we'll start from here, then we'll go to the cash flow, then we have to get a discount factor at some percentage. We'll take whatever is given in the sum, we'll take the same percentage, then we'll get the present value. Once this is done, again we have to do the discount factor at some other percentage, and we have to get the EV. So let's see how it works. So we have to start from the 0th year. 1, 2, 3, and 4. 0th year is always a minus. It's a cash outflow, so 60,000. So we'll take the other numbers. So the discount factor is, for the first year, is always 1. For 13%, we have these numbers. So we'll mark up here. So 13%, and for 5-year period, it's this box. Our discount factors are, it's only 4 years. So we'll multiply. So 60,000 would come directly. The other numbers we have to calculate. We have got the numbers. We'll get the NPV here. So NPV is a positive number at 1955. So if it comes as a positive number, it has to be like taken as a negative number on the next attempt. Okay, it has to go to a negative number. If this is a positive number, the other number when we calculate should go to negative. If this is negative, the other number should go to positive. So we'll increase the discount factor 17%, and let's see how the answer works. So for 17% and for 4 years, these are the numbers. So we'll take those numbers. So the first one is always 1. Thereafter, we'll check the numbers. So multiply the cash flow into the discount factor and get the present value. So 15,000 into, so the answer comes to minus 3155. This is a negative NPV. Okay, so we'll now work out the IRR. So the IRR formula works like this. IRR equals to the lower discount factor plus, so we'll open bracket, so NPV at lower discount factor, that's a numerator, divided by NPV lower discount factor again minus NPV at higher discount factor, close the bracket, into higher discount factor minus lower discount factor. So from the earlier thing, we have found out that there are like two discount factors. We have taken two discount factors, 13 and 17. So 13 is the lower discount factor and higher discount factor was 17. So we'll put it here. So that's about the formula. We have to get the other numbers. So the other numbers are NPV at lower discount factor is 1955. That's a plus number, 1955. Okay, minus, there's a minus in the formula. Again, there's a minus in the higher discount factor, minus 3155, minus 3155. So that's it. Once we have inserted these numbers, the answer will quickly come to us. As is a minus, minus and minus gets added. So what happens is we will arrive at a positive number 5110. So that is a positive number. Multiply that number into the difference. So difference comes to 4. Solve this entire part. So from here to here, solve it. So we got 13 plus 0.3825 into 4. Let's see how much we get. We get 13 plus 1.53. So the answer comes to 14.53 percentage. So that is the IRR rate. Okay. So with this rate, if you compute NPV, if you're going to compute NPV, your NPV answer will become 0. Okay. So at 14.53 number, NPV will become 0. If you want, you can try that, but this is the answer. So now, whether should we accept or reject this project? See, the cost of capital is 13%. That means if you're going to, your capital is 13%, and the income that you're going to get from the IRR is 14.5%. That is, your cost of capital, your IRR is higher than the cost of capital. That means you have to accept the project. Okay, so the concept is accept the project. So that's about the IRR. So we have seen all the methods in capital budgeting and investment appraisal. So I hope you have understood it. Thank you very much for watching this video. We'll meet in the next video.